8 mutual fund mistakes you're making and how to avoid them. So have you decided to invest your money in mutual funds? But where do you start? You might be tempted to plump for the latest hot investment opportunity, but don't get too carried away, because you might be making fund mistakes that can cost you dearly. But what is that plethora of errors in mutual funds, and how do you ensure that you are taking the right call in your investment? Unveiling all that for you in today's video. But before that, make sure to like, share, and subscribe to our channel. Also, hit the bell icon to get all our videos on time. Let's get straight into it. Number 1. Regular plans. While regular mutual fund plans seem more manageable, for a few sound reasons, you should steer clear of them. The first is their high operational costs. With so many other investment vehicles out there, it's not okay to pay premium prices for an ordinarily functioning mutual fund plan. Moreover, there's a broker in between, and you'd have to pay him some commission, which might cut a huge fraction of your overall returns. The second reason you should avoid them is the lack of diagnostics as far as individual holdings are concerned. Also, withdrawing from a regular mutual fund can be difficult under certain conditions, like if the market crashes suddenly, because of its nature as an open-ended product. Number 2. New fund offerings. When it comes to mutual funds, there are a lot of choices in the market. While it may be tempting to invest in the new fund offerings considering the sales tag, there are some reasons that can convince you to avoid them. New fund offerings tend to be more expensive than established funds. Moreover, they also tend to have higher turnover, leading to added taxes and fees. Finally, they often need a track record, so it's hard to know how they'll perform in the future. So if you're looking for mutual funds to invest in, stick with the established ones. They may not be as flashy, but they'll likely be a better investment in the long run. Number 3. Sectoral funds. Sectoral funds are mutual funds where you invest in a specific economic sector. While these funds can offer you exposure to high-growth industries, they also come with many risks. They seem more prone to fluctuations in value than traditional ones because of investing in a narrower range of stocks. It means that sectoral funds are more likely to experience large swings in value, which can be hard to stomach. Moreover, here you will invest in a specific sector that might subject you to concentrated risks. For example, if the healthcare sector experiences a downturn, the performance of the related sectoral mutual fund will likely suffer as well. Number 4. Credit risk funds. Credit risk funds are those that invest in bonds and other debt instruments. They're considered to be at more risk of default. While credit risk funds can offer better returns than other types of funds, they also come with higher risks. For this reason, you must carefully consider whether these funds are suitable. Keeping some basic things in mind is essential if you consider investing in a credit risk fund. One of the biggest threats is the possibility that the company or government will default on its debt obligations. This could lead to massive losses. Another risk to keep in mind is interest rate risk. Here, the rising interest rates could lead to losses for the fund. It's also worth noting that credit risk funds may see greater swings in value than other mutual funds. Number 5. Low AUM funds. One mistake that many investors make is investing in low AUM debt funds. AUM stands for Assets Under Management, and low AUM debt funds typically have less than $50 million in assets under management. While these funds may seem like a good option because they usually have lower fees, they can be risky. Low AUM debt funds typically have less money to work with, so they're often more volatile than other mutual funds. For this reason, their prices are pretty unpredictable, which may lead to losses if you're not careful. Another reason to avoid low AUM debt funds is that they're often less diversified than other mutual funds. This means they're invested in fewer types of securities, which can make them riskier. Number 6. Actively managed large cap funds. You can employ several different strategies while investing in mutual funds. However, not all plans are created equal. One method that has become increasingly popular in recent years is actively managing large caps funds. While there are certainly some benefits to this strategy, there are also some reasons to refrain from actively working on them. The high price tag is the major drawback. You may end up with less money than you invested due to the high fees of these funds. Another critical reason to avoid them is that you may not actually beat the market. While the goal of these funds is to outperform the market, the reality is that they often don't. In fact, a study by Standard & Poor's found that actively managed large cap funds underperformed the market by an average of 1.4% per year from 2004 to 2014. For these reasons, it's better to prefer sticking with low-cost index funds to track the market. Number 7. Fund of funds. A fund of funds is a specific type of mutual fund that keeps investing in even more mutual funds. Although this may look like a promising opportunity at first glance, there are some drawbacks to investing in this field. One of the biggest reasons to avoid investing in a fund of funds is the fees. You're not only paying the costs for the mutual fund, but also the prices for all the other mutual funds it invests in. Over time, this can amount to a sizable sum of money. Another reason to refrain from investing in a fund of funds is that it can be challenging to track your investment. You may need help to see how your investment is performing. This can make it difficult to make informed decisions. Number 8. Cool but clueless funds. When choosing a fund, avoid those that are cool but clueless. Some funds become popular because they have good marketing or track records in the short term. However, they may be run by managers who frequently need more experience or change strategy, which can lead to subpar performance. Additionally, many of these funds have high fees, which can affect your returns. For example, the Fidelity Contra Fund has an expense ratio of 0.74%, but that of the Vanguard 500 Index Fund is only 0.05%. Over time, those higher fees can add to your returns. So, when choosing a mutual fund, do your research and invest in a fund that will give you the best chance for success over the long haul. By avoiding these 8 mistakes, you can ensure that your investment strategy is on track and that you're maximizing the return on your mutual fund investments. Do your research, diversify your portfolio, and stay disciplined with your investment technique. That's how you'll be well on your way to success. Also, don't forget to share your tested mutual fund strategies with us in the comment box.